an original MCM production.
Now, to introduce our program, I'd like to call upon Bill Levitt, arbitrator and mediator of Levitt ADR LLC, who will introduce today's speaker.
Good afternoon. Thank you, President Joanne, fellow Rotarians and guests. It's, excuse my voice, but it's my pleasure. I was conducting a mediation all day yesterday and ran out of voice. It's my pleasure to be able to introduce to you Michael Williamson, whom I had the pleasure back in 2012 to help recruit in my capacity as a trustee of the State of Wisconsin Investment Board to the position of executive director, which he presently holds. And I should say that we recruited him despite the fact that he showed up in a Stetson hat and cowboy boots from North Carolina. But Michael is the amazing head of an amazing organization. SWIB is one of the best kept secrets in the state of Wisconsin. It is the 9th largest public pension plan in America with over $100 billion assets under management, most of them pension assets. And it's the 25th largest pension fund of any type in the world. And generally you don't hear a lot about it, but it's also one of only 2 fully funded public pension plans in America. And if you look at our friends down the road in Illinois, it's quite an accomplishment. As I've already alluded to, Michael is a native of North Carolina. He is a dyed-in-the-wool Tar Heel who bleeds baby blue. He has both a bachelor's degree and a master's of public administration from Chapel Hill, and after graduating he spent 15 years in Madison working both for the mayor of Madison, for the UW chancellor, and for the governor of Wisconsin. So he had an interesting leg up when he came to us at SWIB back in 2012. And he also ran the North Carolina retirement system for 10 years, which I think it's a little smaller than SWIB. I think it's 10th largest in the country. And he also spent some time at the District of Columbia Retirement Board. I'd just like to also mention, although the other 2 people sitting with Michael at the table next to where I was sitting have a SWIB connection. They were introduced, but not with their SWIB connection. One is Paul Stewart, who is a SWIB trustee, and he's here in Milwaukee with his own firm, PS Capital, and the other is Chris Prestigiacomo, who is a portfolio manager on the very successful private market side at SWIB. So with no further ado, you came here to hear Michael Williamson, not me. So here is Michael.
Well, thank you so much. Can you hear me back there in the corners? Good, good. Well, I want to thank you for having me here today, and I want to thank Bill for that very generous introduction. I'm just sorry that my fiance and my mother couldn't be here to hear it. My fiance would have enjoyed it, and my mother would have believed it. And I also want to thank Bill for his 12 and a half years of service as a SWIB trustee, particularly his leadership, his steady hand on the tiller, particularly during the Great Recession. He was there when things were pretty dim and there was lots of tough choices, but as providing the policy leadership to help that organization come through. So I'm really thankful to him for his legacy in the organization. As Bill already told you, I'm a Tar Heel. Anybody here from Duke? Anybody graduate, got Duke? Your daughter was. Well, with no disrespect to her, but I'll pull for Duke when they play Al-Qaeda. So that's just the way things are. Now, I am a Badger fan too. So I did something when the Badgers played North Carolina in the tournament in basketball. I did something, but my dad would roll over in his grave about. I pulled for Wisconsin against North Carolina. Never pulled for a team against North Carolina in my life until the Badgers played. But I thought the Badgers could go further, and they went to the championship game. And who did they lose to? Duke. It was a very frustrating night for me, I have to tell you. But, you know, it doesn't take long listening to me to know, even if Bill hadn't told you where I'm from, to figure out that I'm not from Wisconsin. I've been here 20 years, and people still come up to me and they say, so you don't sound like you're from here. Where are you from? And I said, well, I'm from southern Wisconsin, down near South Beloit. But they don't believe that either. So let me talk to you a little bit about what I'm going to share with you today. I'm going to talk about three things. First of all, I'm going to talk a little bit about what contributes to help SWIB be that strong, steady economic pillar for the state of Wisconsin. I'm going to talk about who we are and what we do. I'm going to talk about how we invest in Wisconsin businesses. And then I'm going to talk with you for the few minutes that I have left about why it's clear to me and a number of others that the U.S. is facing a retirement crisis. So I want to spend a little time on that. So some of you may not be aware of who SWIB is before today, the State of Wisconsin Investment Board or the Wisconsin Retirement System, the WRS, and I'll refer to both of those. So let me take just a few moments to talk to you about that. So the retirement system, the WRS, is one of the largest pension funds. You heard Bill comment on a couple of these points already, public or private, in the world. And virtually every public employee in the state of Wisconsin is a member of this system. That is, unless you work for the city of Milwaukee or Milwaukee County. Those are two exclusions. And I worked on the legislation that merged this system in 1982. In fact, my master's thesis was on the merger of the WRS because it used to be separate systems. And those two employers are not included. The plan's got over 620,000 members. And it has the distinction, as Bill mentioned, of being one of only two large public pension plans in the country that's fully funded. Now, as a reference point, the average funding level for public pension plans in this country is 71.2%. So as you might expect, we're the envy of many other states and pension plan administrators. Part of the reason for our exceptional funding status is that the WRS provides a rather modest average pension benefit of about $24,700 per year. And our participants share in the investment risk. We are a defined benefit plan, but our participants share in that risk. When we make money, they get increases in their pension. But when we lose money, like we did in 2008 and 2009, like virtually every other investor in the world did, they get reductions in their benefit. It's a very unusual provision in a defined benefit plan. The second reason is that the public employers in the state of Wisconsin make their contributions. I mean, come on, this is Wisconsin. We do what we say we are going to do, unlike some unnamed neighbor state to the south, which Bill referenced earlier. So they've made their contributions. And the third thing is the return on investments, which is around the mission of our organization. 75% of the money that is in the state pension plan comes from return on investments. It's not employee contributions, it's not employer contributions, it's money that we make through the investments. And as of May 31st of this year, we're managing about $110 billion, a majority of which, $102 billion, belongs to the trust funds of the retirement system. So we play a key role in the financial health of the WRS and our many retirees. In fact, I would argue that our financial contribution also extends to the state of Wisconsin. A well-managed and well-funded retirement plan is not only good for the public employees and our public employers, but it's also good for the entire state. The pension plan is a positive economic engine for Wisconsin. More than 85% of the WRS pensions go to retirees living in the state. And as you know, these retirees purchase goods and services, and they pay taxes. And what you might not know is that 1 in 5 Wisconsin residents are either a WRS member or in a family with a WRS member. And you can see on the slide that last year the WRS paid $4.9 billion in pension benefits. And according to the National Institute on Retirement Security, expenditures from public pensions supported over 44,000 jobs in Wisconsin and paid $2 billion in wages and salaries and generated $1.3 billion in federal, state, and local tax revenues. So our investment success helps make those payments and their corresponding expenditures possible. But we do even more for the state. Through our targeted and strategic investments, SWIB has been able to help numerous businesses across the state write success stories that have benefited Wisconsin's economy. Let me be clear. We do not invest in Wisconsin businesses to create jobs or to do economic development. There are other public agencies with that mission. We invest in Wisconsin because we think it makes good investment sense and we intend to make money from them. But we are not an economic development agency. So as you can see from this chart, we're a fully diversified fund with investments in many different asset classes, the largest of which is public equities, with about 50%, which is shown on blue on this slide. And our Wisconsin investments fall into several of the asset classes that's on this slide. Private markets, including real estate, private equity, venture capital, and private debt. Public equities, where we purchase shares of stock in Wisconsin companies. And public fixed income, including publicly traded bonds and certificates of deposit. Today, I want to focus on 2 of those investment categories. The first is the Wisconsin private debt portfolio, and the second is the venture capital portfolio. Historically, the private debt portfolio has been focused on Wisconsin. Over the past 30 years, over $2 billion has been invested in companies that are either headquartered in Wisconsin, have operations in Wisconsin, or intend to invest the proceeds here. In 2015, SWIB's Board of Trustees, and Bill was on the board at the time, approved changes to the portfolio that expanded the investment region from Wisconsin, Minnesota, Illinois, Iowa, and Michigan to also include Indiana, Ohio, and Pennsylvania. We refer to it as the Big Ten Light. Not everything, but you know, Maryland's in the Big Ten now. Come on, I'm an ACC guy. I grew up watching Maryland play Carolina, but that doesn't happen anymore. So the changes allow us to better compete in a region that we are seeing more opportunities and that should mean continued consistent portfolio performance. However, about 90% of the portfolio remains invested in Wisconsin opportunities. The investments in the portfolio are in targeted sectors that include manufacturing, financial, healthcare, utilities, agriculture and food, and retail. So I want to share 3 examples of investments SWIB has made through its private debt portfolio. These include Organic Valley, which is a Coulee Region cooperative of organic farmers and one of the nation's leading organic brands. You may have seen it in the grocery store. Wisconsin Pharmacol, a leading manufacturer of brands in the outdoor recreation and safety markets, and National Guardian Life, one of America's most successful independent mutual life insurance companies. SWIB helped Organic Valley finance new distribution capabilities, while we helped Wisconsin Pharmacol and National Guardian finance asset and company acquisitions. In each case, SWIB was able to fill a specific need by making direct financing available to companies like these that may not be able to get the attention of large investors. And there are many other success stories. I'm sure you'll recognize many of the Wisconsin businesses and companies that we've done business with and helped grow. And we continue to look for and welcome new investment opportunities that fit the portfolio's guidelines and meet the market rate returns we are seeking. And if an investment opportunity does not fit with our criteria, our staff work to identify other potential sources of funding, and we frequently make referrals on behalf of the borrower to commercial banks, private equity groups, or other capital sources in the state. SWIB is also investing in funds and early stage startup companies in the second category that I want to talk to you about, which is the venture capital portfolio. While SWIB's investing in venture capital dates back to the 1980s, our Wisconsin venture capital portfolio began in 2000, and it targets venture capital investments in Wisconsin and the Midwest in both venture funds and direct investments in companies. The goal of the portfolio is to find good, local, early-stage technology investment opportunities. SWIB is one of the most active venture capital investors in Wisconsin. We've committed to 6 general partner relationships with headquarters in or a focus on Wisconsin. And in addition, we've committed to 12 non-Wisconsin general partner relationships and over 20 startup companies, most of which are based right here in the state. While not household names yet, you may recognize some of the Wisconsin companies we've invested in. For example, Pinstripe was a Brookfield-based company that provided recruiting services primarily in healthcare, advanced manufacturing, financial services, and technology industries. The company, which started with just 3 employees in 2014, combined with UK-based Okra House and became Cello. The company now has over 1,000 employees and clients in 57 countries. In 2015, Terra Medica, a healthcare informatics company at the Milwaukee County Research Park in Wauwatosa, was acquired by Fujifilm. SWIB was an early investor in the healthcare informatics company, and so while we're pleased with our progress, we continue to still look for new opportunities. And one of these surfaced in 2013 when we partnered with the Wisconsin Alumni Research Foundation, some of you may be more familiar with it as WARF, to create an early-stage venture capital fund focused on information technology. We may have well been the first public pension plan in the country to create our own venture fund, called 4490s, and this is a reference to the 44 degrees north latitude and the 90 degrees west longitude, which represents the middle of the state of Wisconsin. The $30 million fund focuses on early-stage companies primarily in Wisconsin. The private fund, capitalized jointly by SWIB and WARF, is intended to generate attractive returns and build value for state retirement fund participants and WARF's primary beneficiary, the University of Wisconsin-Madison. We've also built strong relationships with many top-tier venture capital funds and have introduced coastal managers on the East and West Coast to investment opportunities in Wisconsin. We support the overall early stage and venture community by partnering with organizations like BioForward, Generator, the Wisconsin Technology Council, and the Wisconsin Angel Network. So we're proud of our investments in Wisconsin, and they're generating returns for our members and for the state as a whole. But with all the success we're enjoying here in Wisconsin, the country is facing a pension crisis. And I could not walk out of here today without commenting on it in the few minutes that I have left. The country as a whole is challenged in the area of retirement security because many Americans are just not prepared financially for retirement, and there's little hope that they will do so by the time they retire. For the past 7 years, I've served on the board of directors of the National Institute on Retirement Security. And according to a nationwide survey we conducted recently, 9 out of 10 Americans believe the country is facing the crisis that I'm talking about. 79% of the Americans agree that the average worker cannot save enough on their own for a secure retirement. And 74 of Americans say that employers are not contributing enough for the workers to have a secure retirement. So it's clear from the survey there's a perception that we have a retirement crisis. But let's take a look at the actual numbers to see if that perception is borne out. 4 out of 5 households in this country have less than one time their annual income saved in retirement accounts. That's 4 out of 5 households have less than 1 year's income saved in their retirement accounts. 1/2 of Americans age 65 and older rely on Social Security for 2/3 or more of their income. The median share of income from Social Security for single women age 65 and older is 84%. So if you're a woman and you're 65 or older, 84% of your income is relied, the median share is relied coming from Social Security. Less than 1/2 of the nation's private sector workforce participates in an employer-sponsored retirement plan. And of those workers who do not participate in that plan, a plan of that type, 2/3 say they have 1,000 or less in savings. So only half of them are participating in employer-sponsored retirement plans, and of those who are not, half of them say 2/3 say they only have $1,000 saved. Incredibly, 26% of Americans age 50 to 54 have no savings, none. More than half of American households have less than 1 month of income available in readily accessible savings to use in case of an emergency. And all of this is occurring while the estimated lifetime cost of health care for a 65-year-old couple is estimated to be $220,000. Baby boomers, or those born between 1946 and 64, expect they'll need $658,000 in their defined contribution plans by the time they retire. But the average in those employer-sponsored plans is $263,000. And that's according to a survey by 900 investors at financial services firm Legg Mason. Americans across the country and all age groups are drastically under-saving for retirement. There are a multitude of reasons for this. You know, some people have to leave the workforce during their prime earning years to care for loved ones. Some are not working long enough to qualify for certain government benefits, or some choose to pay for their children's college and tuition instead of saving for their own retirement. Still, not saving enough was the biggest regret among older Americans, according to a survey of 1,000 participants by the personal finance site Bankrate.com. Not only are they not saving enough, but they're investing too conservatively, and they're paying fees that are too high when they do invest. These numbers are of great concern to me as a former pension administrator and now as an investor. And I think they should be a concern to business leaders and decision makers. If we cannot get a better handle on retirement security, you will see older employees remaining in the workforce longer, fewer opportunities for promotions going to those underneath them, and increasing burden on the social programs in this country to help support them in their later years. I've been saying since 2001, we're going to live in a period of time with an increasing number of elderly living in poverty, and it is happening. However, in Wisconsin, the WRS and SWIB have created a very different picture, and we're proud of our contribution to helping keep Wisconsin strong. We know the work we do today will have significant impact on our members as well as the state tomorrow. We will continue to search for opportunities that will improve the state's economy and make money for our members. By building on a long history of identifying, investing, in promising state companies, we intend to provide investment returns for the trust funds we manage, as well as continue to be part of the blueprints for success of the many Wisconsin businesses. Thank you for the opportunity to speak, and I'll do my best to field answers to your questions. So the question is most of these states are underfunded. What's the reason for that? Are politicians taking money out? Was they just underfunded to start with, or is it poor investing on their part? Well, if you'll remember, in the 90s, everybody was making money. When I took my job as head of the retirement system in North Carolina in 2001, 50% of those state systems were funded over 100%. So the employee groups, the unions, even some of the employers said, well, we got this money, we should sweeten the retirement package. So they increased the benefits right about the time that 2001 and 2002 hit. So liabilities are going up and assets went down. That was before 2008 hit in 2009. So what you've seen is that some of the liabilities went up, the benefits got sweetened, but the bottom line is the market turned. And we're all struggling in this low return environment. We've got what I refer to as the Trump bump going on right now. And it looks pretty solid. We've had pretty good, but we've been in 7, going on 8 years of a strong market. Something's going to turn again. And so it's been a struggle for these plans to get dug out from that. Also, the big difference in Wisconsin is that, as I mentioned earlier, our members share the investment risk. When we make money, they get increases. We don't have a cost of living adjustment that comes automatically. But when we have hard times like we had in 08 and 09, we have drawdowns. Some of our members had a 20% cut over 5 years in their benefit levels. Now, they were some of the oldest ones who had been retired, and some of their benefits were twice as large as it was when they retired, because we have had good years and we increase them. But all those things contribute to the woes of the other states. Yes, sir. The question was, what type of return have you been getting and what are you projecting? And I'll tell you, the first question is easier to answer than the second. If I could predict the future, I wouldn't be working for the state of Wisconsin. So last year we were at 8.6%. I looked at the numbers yesterday from last week. We're sitting at 7.8% right now. So our assumed rate of return that we have to earn every year over the long 30-year period is 7.2%. So we're above that. Our projections are out there that we're going to earn 6.2 for the next few years. We're trying to do some alternative strategies. We're looking for alpha. We've created our own hedge fund on the inside. We're doing multi-asset investing. Our private equity is generating good return for us. Real estate's in a little bit of a slump right now. But our actuaries tell us, and our projection, our asset allocation consultants tell us to expect 6.6 to 6.2 for the next couple of years. And they're forecasting this for a 5-year period of time. So we're in a low return environment. Again, this Trump bump has kind of skewed things a little bit. I hope it continues on. But I can tell you in the 90s, we were getting 8, 9% from 30-year treasuries. I remember, I'm old enough to remember, I think many of you are, when you used to get 5% on a passbook savings account. And people laughed at you because you had your money in there. Have you looked at your savings account lately, what you're generating? You'd be happy to get 5%. So times have changed, and it's directly related to the Fed's policy to lower the interest rates. We're making nothing off of cash now, and that's really pushing all of our other asset classes. Let's see a hand over here. Yes, ma'am. So the question is, besides the market, what are the threats to the pension fund? Well, I'll tell you one right off the bat is the retirees are just living longer. I had the same problem in North Carolina when I ran that system, and I introduced a program that encouraged smoking, drinking, and running around. They didn't live as long, but they were a lot happier. So longevity is a challenge, and we're taking 0.5% off of what we earn every year and putting it back into the fund just to fund the fact that people are living longer. I think the other one is knee-jerk political decisions about the system and what's occurring and how we can better manage it. We're a 30-year system, and we get, people say, well, you should lower your assumed rate. 7.2 is too high, and it may. But, in the early 90s, people were saying we should raise it because income's coming in. We ought to have a 10% expectation on our return. We're 30-year investors. But unfortunately, the political system also oftentimes has a shorter timetable that looks something like the next election date. And so I think that's one of the biggest dangers to that is, and that we're seeing people move away from defined benefit systems to defined contributions. In the 80s, 70% of the workforce in the country, doesn't matter whether it's public or private, were involved in defined benefit systems. Now it's less than 20%. And so, okay, people got 401k accounts, you got 457 accounts, you got 403b accounts, but history and research has showed time and time again, individuals do not have the discipline to set that money aside, nor do they have the expertise to make good investment choices. And as I said, they invest too conservatively, and they pay too many fees when they do that. So on our 401k plans, what we need is automatic enrollment. When a new employee comes into the organization, they have to opt out. We know that human behavior is much harder when you have to opt out of something. So you put them in there, you have automatic escalation. They get pay increases through their career, they keep contributing the same amount. It needs to adjust. So we can change our policies to help encourage people to be in there, and employers need to play a role in that. And if you don't believe that, if you think it's not in your best interest, over time it will prove to be the case, because their workers are staying in the workforce longer, they're not creating opportunity for our younger, more talented employees to move up, and they will leave your organization. If they cannot move up, they will find a better job that's more challenging and pays them more money somewhere else. So it's in our interest to have a system that works. This is systemic. It's not an individual little policy piece. Yes. Now we're wading into preaching. So the question was, how did it happen that the city and the county did not get in the system? Well, I don't know exactly because I wasn't behind the doors. I was working on the issue, but I was a lowly budget and policy analyst working for Lee Dreyfus at the time. You remember Mr. Red Vest? He was a great guy. But my job was to kind of take the decisions. But here's what I think happened. You had all these multiple systems around the state. You had a teacher system, you had a local government system, you had a state employees, you had individual counties and cities had systems. And the legislators got tired of getting whipsawed. The firefighters would get a benefit increase, and then the police officers would want a benefit, and then the school teachers would want one. Well, that was a period of time when the unions were fairly influential. And so the legislators and unions said, we're going to come together, we're going to create one merged system, and we're going to treat everybody the same, because the different lobbying groups are more effective and they're getting changes. But that means that we're going to have to find a common denominator of set of benefits that applies to everybody. Some benefits were higher, some were lower, so that's the negotiation, that's the horse trading process that occurred. I think Milwaukee City, Milwaukee County employees maybe had sweeter package than the rest, and that meant they would have to come down. Milwaukee delegation was a strong delegation at that time. John Norquist, Jerry Kletzka, people that I worked with in the legislature, they had enough votes to say, we're not going to pass this bill unless you exclude us, because we don't want to be in there, we don't want to come in at the average, and they got voted out. Now, that's my story, and I'm sticking to it. But I'm telling you, I wasn't behind that door, but I was watching from the other side, and I saw, and I talked to the people that participated in it. And I think it was just a decision at the time we're better off. I think time has changed that now. We see a little different. I don't know, somebody tell me when it's time. I see a hook somewhere, I don't know, but yes. Not as a specific cat. So the question was, we reflect, the stuff that we're investing in reflects a lot of what the state's emphasis is for economic development, with one exception, and that's water cluster, water technology. And the question was, are we focused on water? Not per se that I know of. Chris, are you familiar with that in any way?
We've looked at a couple of startup opportunities in the water space.
So what he said was, we've looked at a couple of startups, because we are interested in that, but in terms of having a water theme, no, we do not. Yes. So the question is, what percent of the other plans have a shared risk? I'm aware of one other state. It's South Dakota. I know Maine has been looking at putting it in there. And I think we were actually a money purchase plan to start with. Then we went to a defined benefit. And I think how they got the trade-off was, wait a minute, we got the money purchased, we're going to go to a defined benefit plan. There's got to be so there's a safety net of basically what you got. So I think it evolved in discussion. Once again, I got something, you want to take it away, how do I get a protection? And it's interesting that people, you know, what they gave up was this, right? They can go up, and that's what they saw. They never anticipated that they would come down. And quite frankly, until 2009, we never had a negative adjustment in the system. In the entire history of the system, the merged system merged in '82, that was the first time. So I'd like to say it was some grand design that people could see into the future, but I think it was a result of negotiations and a stroke of luck. But it actually has turned out to be a model. And these other systems, if they could go back, and the problem that Milwaukee County's got right now is you can go into the state system with your new employees, but you've got all of these other people who have contract rights and have pension benefit, and you got to resolve that. I'm not in those discussions. Those are going on with our sister agency, which is employee trust funds. But, you know, it's possible to move forward on some existing employees and future employees going into the system, but you're still going to have to deal with that. Yes, sir. Oh, boy, now we're getting into the 301 course here. So the question is, what extent do you see global risk changing in the last 20 years, and how do we respond to that? Well, the simple answer is it's gone up. You know, I mean, we've been recently we've been seeing an onshoring where businesses are bringing workers and work back into North America. Could be Canada, could be Mexico, could be the United States. Part of the reason is transportation costs are going up. Part of the reason is labor costs are going up overseas, but a big part of it is political instability. And if you can't be guaranteed you can get your product out of the country because there's a disruption of some kind, then that increases it. We have gotten rid of our home bias. You know, we are 50, in terms of our stock investments, we are 50% U.S. and 50% global. There's a lot bigger playing field out there than the United States. Now, how does that work for us? Nah, not too good, as they say in North Carolina. You know, being early looks a whole lot like being wrong. And we've been early on this, but our sister systems are coming around and they're taking the same strategy. It's just that the U.S. economy has been amazingly strong in terms of the world playing field. So we still think that we got to be out there. We think there's just too many consumables. There's too much generation going on not to play in that space. We're gonna stay the path. We think it'll pay off. It just hadn't paid off so much now. And here comes the hook. Thank you so much.
An MCM production.